Hello and welcome back to my video. In today's class, we're going to be talking about related party transactions. We have the following learning objectives. First of all, you should be able to explain to me what is a related party transaction. And then what we're going to do is talk about the two different problems or risks that are associated with related party transactions. The first one is that related party transactions might be used to transfer wealth, okay, or in other words, to steal from a company's shareholders. So we're going to talk about how related party transactions can be used in that way. How can they be used to transfer wealth between different stakeholders within a company? And then the second problem is that related party transactions can also be used to misstate profits. Okay. Now, sometimes when a fraud occurs, it involves both of these. Sometimes it involves both stealing and misstatement of profits, but it doesn't always involve stealing. Right? Sometimes it can just be a misstatement of profits. So that's why I'm going to distinguish between these two types of problems. Okay, so we'll talk about that. How can those problems arise? And then finally, and most importantly, from an auditor's perspective, what are the auditor's responsibilities when it comes to related party transactions? Okay, so those are the learning objectives for today's seminar. Before coming to class, you should read through the seminar outline, as always. Here are the learning objectives that I've just talked about. In terms of the reading, you need to read through the class questions and the student presentation that are on the seminar outline. And please note that there will be a pop quiz about the Farmore case, which is question 1 on the seminar outline. Okay, so make sure you've read that case before you come to the class. If you'd like to find out more information relating to the auditing standard on related party transactions, here is the link. Okay, so that's recommended reading. Also recommended reading is this article by Tim Lowers, Elaine Henry, Brad Reed, and Elizabeth Gordon that talks about how auditors sometimes fail to properly audit related party transactions. So what this study does is it looks at accounting and auditing enforcement releases issued by the SEC and looks at those cases where the SEC criticized the way in which the auditors were auditing the related party transactions. So that's quite an insightful article. It's not too academic, right? It's quite easy to read, even for an undergraduate student. This is pretty easy reading. Okay, so that, and it's very interesting reading as well. So that's recommended. And then some additional optional reading if you're particularly interested. It's FAS 57 relating to related party disclosures. And then there's an article by Beasley, Carcello, and Hermanson, which talks about top 10 audit deficiencies and SEC sanctions. And the deficiencies often involve deficiencies in auditing of related party transactions. Okay. But anyway, that's optional reading. You don't need to read that unless you really want to. Okay, so question 1 is about the Farmore company, right? So as you know already, we've talked about this company previously. Farmore was a chain of discount drugstores based in Ohio. But what we haven't talked about with this company so far is the related party transactions that arose in this case. So that's what we're going to focus on in today's class. All right, so there's some information here. One of the related party transactions was involving another entity called the World Basketball League, right? Not the NBA, it's another basketball league, which you can read about here. There were personal payments that were being made to Mickey Monas, who was the president of the company. And there was also another related party transaction involving a company called Tamco, right? There was a settlement that was paid to Farmore. Okay, so this was another related party transaction. Okay, so for this case, what you need to do in part A is explain what were the 3 types of related party transactions. I've just highlighted those for you. And what was the motivation for each type of related party transaction? Right? Was the transaction being designed to transfer wealth, or was the purpose of the transaction to misstate profits? Secondly, how easy or difficult would it have been for the auditors to uncover these related party transactions? Okay, so how difficult do you think it is to audit them? And then thirdly, part C, how valid is Cooper's defense with respect to the related party transaction between Farmore and Tamco? Okay, so when this went to court, Cooper's defended its actions, and I want you to comment on what you think about Cooper's said in its defense. Okay, and then there are some multiple choice questions, and then there is a student presentation that's going to discuss some US companies that were also involved in fraudulent related party transactions, in particular Refco, Enron, Adelphia, and Tyco. Okay, and at the end of that presentation, the students are going to be talking to us about the following questions. Scroll down to the bottom. Okay, first of all, they're going to explain how the companies use related party transactions to commit fraud, right? So what were the nuts and bolts of how the frauds were committed? And then part 2 is asking about key differences between auditing standard 18, which is a new auditing standard, compared to the previous auditing standard on related parties. Okay, so first of all, what is a related party? Well, a related party is any individual or entity that has significant influence over the company. So some examples would be business affiliates, subsidiaries, a parent company, principal shareholders, the family members of the principal shareholders, senior management, and their family members as well. Okay, so it's essentially anyone who has influence over the company, anyone or any entity. So what's a related party transaction? Well, that's a transaction between a related party and the company. So I'll give you a couple of examples. When senior management receive their compensation at the end of the month, that is a related party transaction. Okay. And transactions with a company that's controlled by principal shareholders or senior management. So if the company buys or sells products with another company and that company is controlled by a shareholder or a senior manager of the company, then that is also known as a related party transaction. So with these related party transactions, if they are material, that is, if they are expected to influence the decision of a financial statement user, then they need to be disclosed. So what that means is that if they're not disclosed, that would be a misstatement of the financial statements, right? In particular, it would be a misstatement of the notes in the financial statements, because the notes are required to provide disclosures about related party transactions. And related party transactions are often material due to their qualitative nature. So even if they're small in dollar terms, they can be considered material just because they are so risky, right? That from the point of view of a financial statement user, even a small amount of money that, you know, may be going into management's pockets and duly, that may be regarded as a material transaction simply because it provides information about the honesty, right, and the nature of the company's management, right? So these can often be regarded as material even if they're quantitatively small, right, because of their qualitative nature. Now, we've already seen some examples of fraudulent related party transactions. In the last class, we covered the case of Longtop Financial, right, that had undisclosed related party transactions with Xiamen Longtop Human Resources. But there were other cases that I briefly highlighted in the last class as well. All of these China companies involved allegations of fraud through related party transactions. Okay, so what I'm going to do at the start of the class is I'll talk to you about different types of related party transactions, how they can be used to transfer wealth, and also how they can be used to misstate the financial statements.